This is the reason why you still don't understand market maker models. How's it going, guys? Recently, I received quite a few DMs about market maker models, and I've seen a lot of you guys are still struggling with this concept, so I thought I would quickly touch on this right in today's video. So, starting out on a 4-hour time frame, the thing I really want you guys to emphasize on is bias, right? Whatever time frame you're going to use for your bias, whether that's the 4-hour, the daily, or the weekly, you need to always have a clear directional bias. If I don't know whether price should print lower or higher, there's simply no reason to look for a market maker model, right? The reason why your market maker models fail is because they are not stemming from a draw on liquidity. What do I mean by this? You do not have a draw on liquidity, therefore the model is not valid. The only time a market maker model is validated is when you have a draw on liquidity. So the common misconception with this is that we need to find a market maker model to find our draw on liquidity, when in fact it's the complete opposite, right? Once you have a draw on liquidity, you're simply using the market maker model framework to trade your way to that draw on liquidity, not the opposite way around. So just to clarify once again, a market maker model does not give you a draw on liquidity. So now that we understand that, I'm going to walk through a trade using the 4-hour time frame as our higher time frame, right? So marking out range high to range low, here we have our current trading range, and here we have a fair value gap resting in the premium, right? So this will be our internal range liquidity, and this will be our external range liquidity. So if you haven't watched the previous video, please go back and watch that. This is, a very simple way to get bias, moving from internal range liquidity to external range liquidity, right? However, although our draw is all the way down here, we don't need this whole move to make money, right? We just need a piece of this move, a portion of this move downwards to make money. We don't need to, trade the whole way down towards this low. And I'm going to show you guys how we're going to do that, right? So the next thing now is we need our kill zone. So let's play price out until the London kill zone. Okay, it's a bit too far. So here we are. London open kill zone. Here it is, right at 2 a.m. So at 2 a.m. we get another push higher. We have an accumulation here, a run higher, a manipulation, and it looks like we're beginning to distribute a bit lower. So the reason I said earlier why we don't need to take this trade all the way down to this 4-hour low is because we can use the 15-minute time frame to frame our draw on liquidity as well, right? So we have this low here, we have this low here. These are relative equal lows, right? These lows here, and we have this low here, right? These are all valid draws on liquidity to trade towards. Why do we need to hold the trade all the way down here when it can easily reverse, right? Additionally, if we mark out this range low to this range high, the lower we go, the higher chance there is of a reversal. Why do I say that, right? Because we are trading into the discount of the range. This here, these relative equal lows here are in the premium of the range. So if price is going to reverse, ideally it should take out these lows first, go into the discount, and then reverse, right? So this is a very nice safe draw on liquidity, right? This is a very underutilized concept and it's really important. I really want you guys to go and test this, right? So essentially we're trading from a premium to the premium of the retracement range, right? We don't have to trade all the way into the discount because there's a high chance of a reversal in the discount, right? By trading, just above the discount, we're playing it very safe, right? We're taking the easiest target, which is how trading should be. You want to take the easiest trades always. Okay, so once again, we've traded higher, and here we have our order pairing. If you don't understand order pairing, watch the previous video on buy and sell programs. That will help massively. So the 50-minute has displaced now, and we've violated this fair value gap here. We also do have another video on this sort of entry model where price doesn't need a market structure shift as long as it displaces through a discount PD array. This is more than valid, right? This is now valid to look for shorts towards these lows. So I'm now going to go into the 1 minute because we have what we needed, right? Let's just mark out that 15-minute fair value gap. Okay, here we are, and now on the 1 minute. So now, if we actually go to the 5 minute first, right, I want to show you guys something. So I just showed you guys, going from the 4 hour internal range liquidity to the external range liquidity here. What can we now see, right? From that, we formulated a nice 5 minute market maker sell model, right? Did you see how we didn't instantly go and look for the pattern? We've used logic to frame a bias and a narrative, and then finally we begin to see the market maker sell model, formulate, right? We can now see this market maker sell model. We haven't just gone straight onto the 5 minute and said, here's an original consolidation, this should go, no logic behind it, it has to go. That is pattern based trading. What I've showed you guys is logic based trading, right? We've built up a whole story, a whole narrative as of why these equal lows on the 15 minute should go. These equal lows on the 15 minute is a 5 minute original consolidation of the market maker sell model, right? This is how I want you guys to trade, by building your narrative logically like this, right? Here, let's go back onto the 1 minute and let's see what happens, right? So on the 1 minute, we trade into this 15-minute fair value gap. And, once again, we have that entry model. We have that fair value gap being disrespected. We can put that in gray. And let's play this out a bit more. Okay, here we are, right? We then trade back into this inversion fair value gap and trade lower once again. So for me, this is a valid entry now. We can look to find an entry. I don't really need a retracement, right? A retracement to get back into the trade is totally optional. This is more than valid, right? You can easily market execute here with your stop loss in a nice safe place and your TP at your draw on liquidity, right? Or you can wait for price to return into this fair value gap, which might not always happen. A lot of the time, it doesn't happen, right? So for me personally, this is a valid place to get an entry, or you could wait for price to trade fully through this fair value gap, and then we can get involved. This stop loss is a bit too small for me. I would like a minimum of 5 pips. So if you were to get your entry here, this is perfectly valid with our draw on liquidity at the 5 minute original consolidation. If we go back onto the 15 minute, it's one of the closest lows on the 15 minute time frame, but we don't need to catch this whole move towards the 4 hour low. So coming back onto the 1 minute, let's play this out. Okay, so once price actually displaces through this fair value gap here, the one that we marked out, and we created a new fair value gap here, this is also a valid entry, right? You could have also taken the entry from this fair value gap with your stop above this high and your TP in the same place. So whichever one you guys, prefer, whatever your entry model is, whatever you're more comfortable with, is how you would have entered on this, right? This is a more conservative approach, and this approach I do prefer a bit more, right? So I probably would have taken something like this, and then we could just let this run out. And we go straight to our take profit, right? For a nice 2.16 R. So that is the correct way of how you're going to utilize market maker models, right? This is a logic based way, and I really want you guys to stop looking at patterns, right? It's very important that you first have a higher time frame draw. You have a narrative, whether that's internal range liquidity or external range liquidity, and then you have a confirmation which validates the model, right? You're not going to go straight from a 4 hour PD array then onto a 1 minute time frame, finding an original consolidation, marking that out and saying this is a market maker sell model. That is not a market maker sell model. A market maker sell model only qualifies as one once we have context and once we have narrative. And once again, you don't need the whole higher time frame move to make money, right? We only need a portion of the move, right? Just trade towards the low hanging fruit, the closest draws on liquidity, whether that's, a 4 hour time frame bias and then 15-minute liquidity or 5 minute liquidity in line with your bias. That's totally fine, right? Go for the easiest and clearest draws on liquidity that will provide you with a good RR and ideally a high win rate. So as always, that is the end of this video. I hope you guys did enjoy that. If you did like this video, please leave a like and comment down below. If there's anything that was unclear, please let me know also. and I will clarify that in the comments. Thank you for watching.